If one wants to understand the interest rate in the banking system, do you think it has reached its peak and it is now stabilized and there is hardly any scope for tinkering?
I think more or less, as far as the interest rate on deposits are concerned, whatever increase in policy rates have happened, they have already been passed on. Policy rates are only one of the component which helps in determining the interest rate scenario. There are multiple other factors also which influences the interest rate decisions. But having said that, I must also mention that more or less, to my mind, they have already peaked, and going forward, perhaps we'll get to see some marginal changes here and there. But I think if we look at medium-term trajectory of the interest rate, perhaps it would be on the downward swing.
Given the high interest rate scenario prevailing today, do you think that RAM segment will see some moderation from 16-17% growth rate during the current year, or it will continue to hold this kind of pace?
I think when it comes to the RAM segment, essentially the banks have got very elaborate process of assessing the risk and underwriting such credit exposures. So I think the way I look at it is that the current book looks pretty good, touch wood, and we don't have any challenge. We can comfortably grow at about 16% as far as the RAM book is concerned, and we don't envisage that this interest rate impact will be seen in terms of the quality of the loan book. So, because when we are making assessment for underwriting, we are quite cognizant in terms of the likely interest rate scenario and the ability of the borrowers to repay the loans in time. So, that is one of the reasons why this confidence is coming that perhaps RAM book will not witness much of a change. It can afford to continue to grow at about 16%. Absolutely no. In fact, when we look at our book, our gross NPA in this whole of retail portfolio is within 0.70 gross NPA. So that is something which is nothing but a reflection of our underwriting standards and our ability to pick the right quality business. We are seeing adequate opportunities for us to underwrite such business, be it mortgage loans, be it car loans also.
On the corporate side, the government has put a lot of thrust on Capex, and as a result, steel, cement sector has seen some sort of private investment moving up for capacity expansion. How do you see this segment for you, and what is your anticipation from the corporate loan side during the current financial year?
Yeah, when it comes to corporate borrowing, they have, in the past we have observed that they were having sufficient surplus cash on their balance sheets, and initially they were dependent upon that excess cash in their balance sheet for supporting their fresh investments. Now we have come to a stage where they have started approaching the banks also for augmenting their capacity or for working capital purposes. But yes, of course, this I can say with confidence, because when we look at our unavailed term loans, the percentage has come down from about 25% to about 18%. And when we see the working capital utilization, even that has also improved. And also at the same time, when we look at our pipeline for the new proposals, that is also quite healthy, somewhere around 5 trillion or so. So all this is a reflection that private sector opportunities are going to be there for lending, and we will be in a position to create value for our private sector customers as well.